You know, in this channel, you always hear something a little bit different. That's why today we're touching on this topic. A time when US shares actually sucked. Because that time seems so far ago. Right now, people are all hyped up about US shares. Everybody, especially new investors, are keen to buy US shares, buy Apple shares, etc. etc. But actually, there was a time really when US shares actually sucked. There was a time where US was thought to be slow growth. There was a time when US actually was out of favor and emerging markets was in favor. That period of time was in 2007. You know, looking back at what US shares has did versus STI index, I'll put up for you to quickly see in this chart over here. You realize that US shares have actually outperformed STI index by so much. They've done 60%, whereas STI index has gone nowhere. No wonder some people mention this, that US shares own all the biggest brands in the world. STI cannot match that kind of might and strength. That's why you should only buy US shares. But today you're going to hear something different. If this interests you, continue watching on. What is exactly in the S&P 500? Right now you see the top names are all tech firms. Even Google, who's number 6, actually should be back up on the top 5 because they are broken down into 2 share classes. So actually everything in technology is dominating S&P 500 right now. And that's why if you look back at 2007, just how I mentioned, that was a time whereby actually STI did way better than US shares. If you compare the Singapore STI versus S&P 500, you realize that STI actually outperformed significantly in the 5-year period 2003 to 2007. Everybody was hyped up about emerging markets. It's not just only STI. Most emerging markets actually did better than developed markets, including US shares. What about NASDAQ? NASDAQ seems to hold all the best technology firms, all the most rah-rah ideas there is in the market, new tech firms, unicorns, etc. etc. But there was a period of time in that period whereby in that 5 years, NASDAQ was horrible. If you look at this chart over here, you realize that in that period of time, NASDAQ just went through dotcom bubble. It was the next few years after recovery, and they were awful, to be honest. And in the top listing of S&P 500, you will not see that many technology firms. That's why the situation has changed drastically. When it comes to investing, you should always think back in time of history. Is this always going to be what is going to be reflected moving on? Because if you're all hyped about US shares and you neglect other opportunities, for example in STI index, you may be missing out on a point whereby there was a period of time whereby US shares actually sucked. Apple shares have been going up. That's why many people are very interested in investing with Apple shares. Having said that, Warren Buffett has actually sold a small portion of his stake in Apple, locking in some gains. Warren Buffett actually took very long to move into technology, but he has actually done so in a couple of years already. And before that, he used to buy IBM before moving to Apple shares. But again, if you're investing in Apple, you're moving forward with Apple. So again, decide whether Apple shares is something that interests you. What about for Tesla? Tesla is something that is very hot right now, but it's moved up 300% in the last four months actually. Look at this chart over here. You realize that it has spiked up significantly, doing 300% in this very short period of time. And all this is done while actually not having any profitability at all. So you have to question as an investor whether that is something that you like moving forward also. Before I share with you what I found in terms of recommendations, I invite you to smash the subscribe button below and join our community to become more financially savvy, because I'll be sharing videos like this on investments, on retirement planning every week to help you in your journey to become better off financially. Now, this is actually by Pimco. Look at this over here. This is Pimco's research. They are actually one of the biggest fixed income asset managers. Pimco actually overweights on US equity. Overweight means it gives it bigger allocation than other sectors. What about for IFAST? IFAST is a Singapore listed share, Singapore listed brokerage. And IFAST research actually came out with underweight, unattractive for US shares. So even the opinion between research houses are different. So factor that, take a pinch of salt and decide for yourself whether US shares are worth investing into. In any case, if you're interested in investing in US shares, take note of this. There's always a withholding tax, a 30% withholding tax when it comes to owning US shares. So if they declare dividends, there'll be a 30% cut off from that. So take that into factor when it comes to investing for your own dividend strategy itself. So with that, I would like to invite you to leave in the comments below, just in case I miss any portions that are unaddressed. I'll pick up each and every question that you may have. With that, I'll sign off. Take care and goodbye.